Okay, hi guys. Welcome to another Freelancer Finance. Let's talk about why some people think, especially big investors, that this might be the biggest bubble of our lifetime. So, are we in the biggest bubble? Let's listen to what Stanley Druckenmiller has to say about this.
If I was Darth Vader and I wanted to destroy the US economy, I would actually do aggressive spending in the middle of an already hot economy, which is exactly what we have. The reason is that creates two things. Number one, you usually get a bubble out of that. And number two, you could get inflation out of that. Frankly, we have both. This is the biggest bubble I've ever seen in my career.
Okay, that's Stanley Druckenmiller. Let's listen to Jeremy Grantham. And he believes the stock market's going to crash the S&P to 2,500. Let's listen.
The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
Now, what does it mean that the S&P is going to go to 2,500? We're going to discuss that in a second. This is the history, the monthly chart of the S&P. I'm looking at the SPX. It's currently sitting at 4350. It's actually down on the day. The Fed meeting is happening concurrently to what I'm actually recording. So having seen the S&P down, maybe it didn't go as well as everybody wanted. I mean, that's the market. Come on. We might have some pain going forward, but let's discuss Jeremy Grantham. This is the S&P from back in 1945. If you look clearly, it's in an uptrend in this channel between the two orange lines. And I want to show you this because I want to show you how long the S&P has been moving up. And obviously new companies come into the S&P and old companies leave. But this shows you that the growth for the last 70, 80 years has been insane. That if you invested and held on, which is important, that you held on, you did really well. Between the two orange lines is our trend up. And I have my green line here, so I want you to quickly look at this. This is my assumption of the trend, not Jeremy Grantham's assumption. I believe Jeremy Grantham's assumption of the trend is this blue line, that the market always wants to return to where this blue line is. And I'll go into why. Let's get a little bit closer to the S&P. If you take a look at it, the reason I drew this blue line, this is my assumption of Jeremy Grantham's statement that the S&P should return back to its mean of 2,500. So here it is. We are at 2,500, the blue line. He's saying that from this point that we are overvalued, it's probably going to go back to right here. Could he be right? Yeah, why not? Because we've seen it down this low in the trend. I would tend to assume that the average is actually more of this green trend, and I'll go into why exactly. But let's take a look real quick. What happens if it does fall down to the blue trend here? Let's take a look how far it has to fall to get down to where Jeremy Grantham's statement of 2,500 is. So it basically has to go around 42%. Now, for me, I think this is possible. That right now, if we started falling straight down, basically it would be around 25%. And we would be at around 3,400, somewhere around there, if it fell straight down. No one's saying this is happening. I'm not claiming this. I just want to show you what his thought process is in terms of saying that it should be at 2,500. Having said that, let's just look quickly in our past if we were to follow this train of thought about Jeremy Grantham is correct. Maybe he is right. Here we have a clean extension of this trend. You can see how far we bounced off my green line, not Jeremy Grantham's. This is important. So this is my average trend heading up for S&P. So if I do another measurement from this point, and I look just how long it even took. First of all, we fell 50%, and Jeremy said that in his video that the Fed backstopped this, so we only dropped 50%. So here you go. He probably would have thought it would have dropped over here more like 60%. I'm thinking that would be his assumption. He didn't clearly say that, but this is what I believe he would have thought, that 60, 70% would be the drop. Okay, so here the Fed backstops us at this point. Around 700 and let's say 800 days pass. We're down 50%. It took 800 days, remember that. Okay, so let's go back up and look what happens in 800 days, approximately. This is just a good thought experiment. This is not meant to be what it will happen, but 800 days from now, roughly in my trend, the green one, if we do continue to fall, then we might end up being somewhere around 3,800. And that would take around 800 days to drop another, let's say 15%. There you go. That would be my assumption, that if we are in this downtrend and we're entering a recession, that the S&P should continue to drop somewhere in the neighborhood of 15, maybe even 20 if it goes below it. Obviously, it doesn't mean you can't capitulate further. Usually when something's tanking, it goes further before it recovers. So we might go below this 3,800 and then bounce back to the mean, right? My assumption, if this happens. These are just all like thought experiments, so follow me here. Now, if he is right and we wait 800 days, even his bearish case of 2,500, here's around 800 days, it would go probably down around 35% as opposed to the original 45%, which is still a lot, obviously, for the S&P to drop. So here we are at 800 days, 35% down approximately, and we're hanging in around 2,900, maybe 3,000. I would say the truth, if this occurs, lies somewhere in between my assumption and his. His assumption is super bearish. Mine is just trying to go with the trend of the S&P. I haven't been doing this for 40 years. Don't follow YouTubers. Don't believe everything we say. We're just trying to discuss thought experiments. And I just want to mention real quick. So we are going to discuss this in our Discord. I'm going to put a link below. And so please join us on the Discord to discuss this further, because we're going to have probably an intense conversation about this and whether I'm being super bearish in this video, but I'm not. This is a thought experiment if Jeremy Grantham is correct, that we may end up between 800 days from now, between, let's say, 15% down, 20% down to 35% down. Once again, if this bearish scenario is playing itself out, we're heading into a recession. The Fed does not save us. The world is ending. That's what is happening. Okay. I want to bring this all up because I do want to get to the positives. But before I get to the positives, let's discuss why he believes this. This is what Jeremy Grantham says. Market Superbubble could lead to 50% plunge, says Grantham. And we showed you why he believes that, right? Because we're at 4,400 and he expects us to go to 2,500 approximately. The US is in a super bubble similar to the stock markets in 1929 and 2000, and could fall as much as 50%, said Jeremy Grantham in a report released Thursday. Recently predicted the popping of the dot-com bubble in 2000 and the fiscal crisis of 2008. The trend value of the S&P 500 index is about 2,500, as I showed you in the previous chart, that he believes that blue line is sort of the trend and it should revert to the mean, right? And the way these guys do it is that if the standard deviation is away from that trend, you guys can look up some statistic stuff, but if the standard deviation is too high, 2 or 3 times standard deviation, that means he's betting on the market coming back to the mean. That's really the point, that he feels that we have gone way too far and we have to return. This could be a fallacy in his thinking, but we'll discuss why too. Grantham said extremely low interest rates led to the highest priced bond market in the US and fueled the equity market to standard bubble level by the end of 2020. But with bubbles forming last year in housing and commodities, such as oil and metals, for the first time in the US, we have simultaneous bubbles across all major asset classes. He said it is much more dangerous to have a bubble in housing, and we are in the most extreme global real estate bubble in history. I don't know if I disagree with him, but housing has been in a bubble for a long time and may continue to be in a bubble. And if you've been following housing, there's not enough housing. You know, whether it'll correct back to what it should be, we don't have enough housing for everybody. More people are being born, more people are buying property, more people are expanding out now out of cities, obviously. So I think the need for housing is increasing, not decreasing. The current bubble is in the 4th equity super bubble in developed countries over the last 100 years, Grantham said. The other 3 were in 1929, which brought in the Great Depression, the dot-com bubble of 2000, and Japan's crash of 1989, which was a bubble in both equity and housing. The fiscal crisis was a housing super bubble, according to Grantham. The most important part of the late stage bubble is crazy investor behavior, which we did have. That is true, which he said were epitomized by the rally of meme and electric vehicle stocks, cryptocurrencies, and NFTs, non-fungible tokens. When pessimism returns to markets, we face the largest potential markdown of perceived wealth in U.S. history. If valuations across all of these asset classes fall just 2/3 of the way back to historical norms, total wealth losses will be on the order of $35 trillion in the U.S. alone. He blamed the Federal Reserve and other financial authorities for allowing and facilitating these bubbles. One more bearish article about Jeremy Grantham. My confidence is rising quite rapidly that this is in fact becoming the fourth Real McCoy bubble of my investment career. The great bubbles can go on a long time and inflict a lot of pain, but at least I think we know now that we're in one. And the chutzpah involved in having a bubble at a time of massive economic and financial uncertainty is substantial. Grantham painted a very dire picture of the investment landscape in the US, suggesting that rampant trading by out-of-work investors and speculative fervor around bankrupt companies, including car rental company Hertz Global, reflects a market that may be the most bubblicious he's ever seen in his storied career. And we did discuss Hertz, so there you go. He goes on to say, it is a rally without precedence, he told CNBC. Grantham is worth paying attention to due to his prescient calls over the years. He said that stocks were overvalued in 2000 and again in 2007, anticipating those market downturns, the Wall Street Journal reports. Now, this is interesting. This is the part I really wanted to get to. Asked what level of exposure investors should have to US equities, Grantham offered an unflinching view that may leave some bulls gobsmacked. I think a good number now is 0, and less than 0 might not be a bad idea if you can stand that. So I think he's basically saying short the market because the US market is about to have a major 50% drawdown, as we saw in the charts. Now, before I go on to the other side, I just want to give a little bit more context to why he believes this. He did have a letter. I'm going to link everything below, and everything's going to be in our Discord as well. So please go check it out. We're talking about everything, stocks, Tesla. We're talking about, obviously, the economy. If this video will be posted there, and we can discuss further about this bubble thing. If this is what you believe, let us know in the comments here on YouTube, and obviously go to our Discord, and let's discuss this further. This is what he goes on to say. In a bubble, no one wants to hear the bear case. It is the worst kind of party pooping. For bubbles, especially super bubbles, where we are now, are often the most exhilarating financial experiences of a lifetime. I participated in a wonderful micro-cap fireworks display from 1968 to 1969, in which I made a small fortune, 7 times the then full cost of a year at business school. My main stock, American Raceways, tripled when I was on vacation from $7 to $21, then went to $100 by Christmas, only to lose it all even quicker by the following June, as almost all of the fireworks exploded and crashed. This taught me a lesson, and it helped make me cautious. The experience also makes it easy for me to sympathize with the view that bearish advice in bubbles always comes from old fogies who just didn't get it or who just don't get it, because I received that old fogey advice back then and just didn't listen. I doubt speculators in the current bubble will listen to me now, but giving this advice is my job and possibly the right thing to do. So once more, unto the breach, dear friends. I'm going to leave a link, of course, to the article because you guys have to read what big investors who have been investing for 40 years, we still have to read what they have to say. It doesn't mean he's right, but we still should know what the opinions are of these people. He says all 2 sigma equity bubbles. And once again, that's the standard deviation away from the mean. So all 2 sigma equity bubbles in developed countries have broken back to trend. But before they did, a handful went on to become super bubbles or 3 sigma or greater in the US in 1929 and 2000 and in Japan in 1989. There were also super bubbles in housing in the US in 2006 and Japan in 1989. All 5 of these super bubbles corrected all the way back down to trend with much greater and longer pain than average. So I just want to make it clear. The reason he is so bearish about the S&P is because he looked at the history of it and he feels this is the trend of the S&P. This is the average where it should be, okay? Remember, this is my assumption of the blue line. He didn't put this in my chart. My assumption is that he feels this is the average of the S&P over the last 70, 80 years. So here you go. He feels that at this point, if we were to go 2 sigma higher based on all the data of the previous years of the S&P, then if you go a certain sigma over, I don't know the exact numbers here, but if you go 2 or 3 standard deviations over, and you could look up some statistic stuff, that basically we are at a point where we're multiple standard deviations over, that this should not be here. We are in bubble territory. We should come back down to something back to the mean. The one thing I want to point out is I don't know where he's measuring the data from, because look, if you go back to the S&P in 1945 approximately, you have one measurement of this data. So this is very important, can measure from different points in history. And I think I might have an episode on what exactly he's talking about and maybe do some statistics on this. Let me know in the comments if you'll actually like me to do the real math, figure out the statistics at different points in history, and then we'll know, how many standard deviations over are we at certain points? Because that matters, right? Because 1945 is not the same as 2022, no matter the math, okay? So that's one thing. The other thing you have to look at, if you go all the way back in history, Look at the S&P. We're talking about 1873. I mean, this is pretty far, right? We're looking at the S&P, 1873, different companies, different stocks. I'm not going to be a history teacher here, and I don't know all the history of what companies were, but I don't think there was a Google and an Amazon here, okay? And the internet didn't exist. So if this guy is doing statistics back in this day, back in 1873 to today, you're going to get different standard deviations for when you take the data. I'm not going to make this a math episode, but it does matter. Let's go to the next article. And this is actually by Michael Batnick. He has a show with Josh Downtown Brown, I believe I'm saying it right, called The Compound. And I'll try to put a link to their channel because it is a good channel. You guys should subscribe. If you aren't subscribed, they go into a lot of charts and detail. So great guys to follow for actual figures. So Michael Batnick, thank you for this article. Grantham is famous for calling the Japanese tech and housing bubbles. So when he speaks on this topic, investors pay attention. It's only fair to point out that he has been bearish for much of the recent bull market. I include these bullet points not to dunk on Grantham, a living legend, but rather to show the full picture. So this is where it goes into that. It's not like Jeremy Grantham came out today and said the market's overvalued, or this year. He's been saying it for a long time, since the last crash. The last crash was barely over. Here, 2010, he's already talking about how it's overvalued. Let me go over these points. 2010, Jeremy Grantham says, have cash, wait for stocks to fall. 2011, Grantham sees most global equities as ranging from unattractive to very unattractive, valuing the S&P 500 at no more than 950. We're going to remember that number. We're going to go back to the S&P in a minute. 2012, Jeremy Grantham warned 2013 will be a dangerous year for stocks. Okay. 2013, much of everything else is once again brutally overpriced. 2014, big stock bubble will end badly in 2016. 2015, GMO founder Grantham says market ripe for major decline in 2016. Okay, even Michael Batnick says, okay, you got the point. Let's go back in history. We're going to look at 2010. We're going to start there where Jeremy started getting negative, okay? We're going to do some tools here. Here's 2010, January 2010, right there. Okay. We're going to go to today. I just want to make this absolutely clear. So we are around here today. March? No, what are we in? January? Somewhere around there. Okay. So we're somewhere around there. Let's see if you listened to Jeremy Grantham after he told you not to invest in the stock market and it's overvalued. Let's see where it would have gotten you. Okay. So let's say you did listen to him in 2010. You're like, this guy knows what he's talking about. You missed out on 327% gains over the last decade or so. Now, this is the main reason that I don't know who Jeremy Grantham is talking to. I don't know if he's talking to only billionaires, but if you were just a regular investor, dollar cost averaging, video again up here somewhere or down there, if you were just a regular investor, dollar cost averaging as we covered, you would never have timed any of this because you would just be buying in consistently over the last 10 years. And if you could take a look at it, you would be up. That's the point. That especially in market corrections, like this big drop, when Jeremy Grantham should have said, you know what, you should go all in. We are at the bottom of a trend. He didn't, okay? As it was going up, he's telling you not to buy. This is why prognosticators and gurus like Jeremy Grantham, including YouTubers like me, you're not supposed to listen to. You're supposed to do some of this homework and figure it out for yourself. But I wanted to go through this thought experiment to see what would happen if I did listen to this guy. And even if he's right today, he's been wrong multiple times over the last decade. So you can't be making a prediction every year and be wrong and then one year be right. Everyone's going to be right eventually. The stock market will crash completely. I guarantee one day in the future, it'll go down 50%. That's my guarantee to everybody watching, right? Pointless. Without a time frame, it's pointless, right? So he is right. It's going to go down. Who knows if it's going to happen today, tomorrow, or in 5 years. So remember, he says in 2011 that the S&P should be no more than 950. Let's take a look at 2011 now. Middle of 2011, the S&P is roughly around 1200. He's saying it should be, he's really saying it should be at the bottom of this trend. He's really like literally at the bottom of the S&P trend. Where I have it, he feels that's where it should be. And that's where it should mostly stay. And that his blue line is the overvalued line. It's kind of amazing. So it was at around 1200. He feels it should be at this orange line at around 900, 950. So even from then, that point, we go up 256%. Okay. I hope you guys are getting the picture. We're just doing thought experiments to see how valuable his information is. That if you just read the article, you might say, this guy's invested for 40 years. He might know what he's talking about. And I'm not saying he doesn't, but he might be, one, using the wrong statistics. He might be taking it farther than we would like because it's a modern era and not 1875. That's one problem. The second problem is he's been through a bunch of crashes, and I have too. That sort of affects your mentality that you don't want to go through it again, right? So even I am much more cautious in certain things because I've been through those moments where I don't want to go through them again. I get it. There's fear involved in it. So he might be living through 4 different moments in time that we are not. He's projecting onto a future that hasn't happened yet. And I'm not saying he's wrong. Okay. I'm not saying I'm right. The point is that we're just doing a thought experiment to see, is what he's saying something we should be listening to actively or just using it as one piece of information in a whole plethora of information? And I think it's just one piece of information. So the other thing I want to point out about this chart, which is important, now that we've looked at, we would have missed 300% returns. And this is the S&P, by the way, only. We're not talking about Google and Amazon and Facebook and Netflix and the 100x, the 1000x you would have gotten somewhere else. We're talking about the safest investment in the stock market, the S&P, that you would have missed out on that. And imagine if you listened to Jeremy that stocks are supposed to be cheaper and you weren't buying Google because, you know what, it's overvalued. It was. Amazon, overvalued, had 50, 90% corrections. So if you were listening to just this voice and other bears talking about it, I think you would have missed a large part of this run. And that's my point. We don't know if this is the top. I want to show one other thing on this chart that's important, that if he's right, let's say the S&P does drop and it takes around this much time to drop to get to here, that we're in a negative spiral for a while, a year, 2 years. So here we go. We're dropping and we're probably not going to hit to 2,500. Like I said, we're probably going to hit to, let's say, 2,800, somewhere around there. The other option, not saying this is happening. This is the problem with predicting things, that we can be heading higher for many more years. And then at that point, the correction happens. My point being that we don't know where this will occur, whether we rebound off of some moving average, we head steadily up for the next 3, 4, 5 years. Who knows? It could be 10 years. Like, honestly, we don't know where this happens. So I'm just making this clear. This is just a thought experiment that we're going through. And on the Discord, we're going to talk about this. But the thought experiment is that, okay, what if this bubble continues like it has in the past? And sometime in the future, who knows where, we do correct. And we're sitting, we go all the way up to like 7,500, and then we drop back down to 5,500. So that is, all of these situations are possible. That if we do not completely capitulate here, back to the mean, my mean is around here, around 3,500. His mean is probably going to be around 2,800 in the next couple of years. So the reason I'm bringing up that both scenarios are possible is that I don't know the answer to this. So my only option is to just dollar cost average this down or dollar cost average this up. If I knew the answer, then obviously I would just wait for the perfect moment. If I knew that this was tanking here, then I would just wait for 2,500 and just sit on my butt and just wait the whole thing out because I knew it was going there. But we don't know. The thing is, let's say even if he's right about this bearish territory and it goes somewhere over here over a longer period of time. So now all this time I could have been dollar cost averaging. And then at that point, just to make it clear, it takes off like a rocket again. Like, we don't know the answers to this. So this is the problem I find with Jeremy Grantham every year telling you not to buy stocks. You as an investor should look at all of this type of information, do this thought experiment yourself. And in my opinion, as this goes down, the only thing I want to do is dollar cost average in to get a better price on the positions I have that I really like. Enphase, you're in this video. Congratulations. You've made it. But if I get a better price on Enphase, as long as the fundamentals of the company do great, like, okay, so I have to wait more. Like, I won't have my yacht until 2030. I understand it sucks. I want my yacht in 2025. But the point is that I get the dollar cost average on the way down, and then I get the dollar cost average on the way up. At some point I will stop, right? Probably not, because I expect to invest for the rest of my life until I die. So at some point though, we will be in this trend again. And Jeremy Grantham is not talking about that part of it. He's just talking about the negative side of it. He's talking about the side that everything goes to shit. And I'm trying to say that maybe everything doesn't go to shit right away. Maybe it takes a little bit of time to play out before everything goes to shit. Okay. And I'm leaving the shit in this episode so you guys can hear it, because this is ridiculous that we don't know the answers to these questions. Okay. So you guys should take this chart, this S&P, do some thought experiments, run these things, read all these guys and make your own decision. But as far as I'm concerned, I'm going to DCA until whatever, whether it's here or there. I'm just going to keep putting money slowly into the market. The main point is that it's slowly and it's not all in at once, because I don't want to be left out in the cold if this scenario plays itself out. Now, let me preface this. I don't know what scenario will play out. I have no idea. Jeremy has no idea. None of us do. That's why the only strategy for me that it's going to work is to dollar cost average this whole time. I consider myself a bubble historian and one who is eager to see one form and break. I have often said that they are the only really important events in investing. I have come to believe, however, very reluctantly, that we bubble historians have, together with much of the market, been a bit brainwashed by our exposure in the last 30 years to the 4 of the perhaps 6 or 8 great investment bubbles in history. Japanese land and Japanese equities in 1989, US tech in 2000, and more or less everything in 2007. For bubble historians eager to see pins used on bubbles and spoiled by the prevalence of bubbles in the last 30 years, it is tempting to see them too often. Basically, he's saying, I see bubbles everywhere. Okay, so this guy can't help it. He's been through a lot. He's been investing for 40 years. He can't help but to see all the problems that are approaching us. And it's not that he's wrong. We do have problems approaching us. But to take the stance that everything's going to crash and burn is also not the correct thing to do. It's been over 4 years since he wrote this. Now he sees bubbles again. So let's see what he says now. The one reality that you can never change is that a higher priced asset will produce a lower return than a lower priced asset. He's right. I mean, the higher something goes, the risk gets more, not less, right? So this is why when things are crashing and becoming more normalized, that's why we DCA in a little bit harder as it goes down. You can't have your cake and eat it. You can enjoy it now, or you can enjoy it steadily in the distant future, but not both. And the price we pay for having this market go higher and higher is a lower 10-year return from the peak. He's probably right about this in the fact that the higher the assets get, that it does become more risky. It's not that as the price goes up, it gets less risky. It's more risky. But now it's reversed itself and assets are coming down. So shouldn't his advice be careful? It's still overvalued, but you have to DCA in the market if you're a long-term investor. So we've heard all these bears. We've heard Stanley, Druckenmiller, Jeremy Grantham. We've heard Michael Burry, and we know what John Paulson thinks. But what do we do as regular people, like I keep going back into? Well, we actually did an episode on it. It's Investing 101. What is dollar cost averaging? I'll include a link above and below. And I'm just going to dollar cost average as we see all of these spikes happen in all our companies, especially our favorite one, Enphase. I think that's the right strategy for me. You guys have to do your own thought experiments and do your own research and see what's right for you. Obviously, join our Discord. We're going to discuss this and more in it. I'm going to leave a link below. And our Patreon is only $1 a month, so join it. And then you can have access to private Discord channels that we discuss and release episodes early. So thanks for watching, and see you on the next one.